The two most popular and simplest investing methods are called lump sum investing and dollar cost averaging. In the first method, you invest a big amount of money once, for instance $10,000, you set it and forget it for many years and hopefully benefit a nice profit many years down the line. In the second method, you split that $10,000 into smaller amounts, for instance $200, and you invest that same amount on a regular timeline, for instance every month. In this video, we're going to try to figure out which one of these approaches makes the most money. Quick disclaimer, none of the insights contained in this video should be considered investment advice. I'm not an expert, I'm not a certified trader, I'm not an investor, I'm just a guy who likes to look at data, analyze it, and share my insights. So the problem with the strategy that makes the most money is that it's also the one with the higher entry price, the one where you invest $10,000 once. Most people don't have $10,000 lying around, and if they do, they may not feel like risking it all at once or seeing their portfolio lose a ton of value in a bad year. And that's why we came up with the dollar cost averaging approach. In this video, we're going to backtest both strategies with a standard investment in the S&P 500, which is a stock market index that tracks the stock performance of 504 of the largest companies in America. This index is generally considered a solid long-term investment because it encompasses a lot of different industries, so you get automatic diversification, and also the overall trend of the index is going up. Over the past 91 years, only 25 had negative results, and the average yearly return of the index has been between 10 and 12%. We will invest in that index through the Vanguard S&P 500 ETF, and we will use an investing timeline of 30 years from February 1992 to today, November 2022. So back to the studies that compare both strategies. Say you had invested $10,000 once in February 1992 in the S&P 500 and you didn't touch that money up until today. That's lump sum investing, and using this method, you would now be sitting on $202,362 or a 1,923% increase, which is really good. That's amazing. Now for dollar cost averaging, we're going to use the same amount of money, take that $10,000 and split it in monthly investments. So from February 1992 to November 2022, that's 370 months. We divide $10,000 by 370 months and we get a monthly investment amount of $27. Then we take that $27 and invest it every month from February 1992 to November 2022. We would now be sitting on $58,496. So that's a return of 488%, which is also really good, except it's way less than in our previous example with lump sum investing. So there's no question that lump sum investing has better returns in theory, but in practice, things are just not that simple. So let's take a look at something called drawdown graphs. A drawdown graph shows the periods in time when your portfolio was down compared to a previously achieved peak. Let's start with the drawdown graph of the lump sum investing approach. The longest and deepest drawdown period lasted for 13 years and 4 months, and that was between August 2000 and December 2013. It reached the bottom at minus 60.4%. This means that while your portfolio did sometimes increase in value within that time frame, for instance, it increased 56% from February 2003 to May 2007, its value peaked at almost $60,000 at the end of 2000, and then it didn't increase anymore for 13 years. That's rough. Let's now look at the drawdown graph of the dollar cost averaging approach. Here we see that the longest and deepest drawdown period lasted for 6 years and 7 months and was between October 2000 and May 2007. It reached the bottom at minus 47%, which, quick math, is twice as short as the lump sum investing drawdown and 23% less deep of a bottom. So that's much better because it means that you're bleeding less money in times of crisis, and this also points to one of the major pain points of lump sum investing: emotions. So again, for most people, having $10,000 in cash at hand is a lot of money, and investing that amount will most likely make up a big chunk of their savings, so emotions are going to get involved. When you see your portfolio lose 60% of its value over 12 years, you might feel like cashing out before recovering your losses. And of course, you will still have made a profit compared to your initial $10,000 investment, but once you're out, and you most likely won't dare to invest again, especially in the middle of a crisis. And although $50,000 is a nice profit, I think we can all agree that this type of wealth is not going to last you a lifetime. With dollar cost averaging, as we saw, an economic crisis will have less impact on your portfolio, and you will never feel like you're all in financially because you invest an amount you can afford every month. And that's a major game changer because it gives you financial flexibility and also peace of mind. And now for the most important part of the video. Again, maths don't lie and lump sum investing beats dollar cost averaging most of the time. But the problem is that studies compare the two strategies with the same amount of money. And of course, it's mathematically fair and accurate to do that, to compare two different outcomes with the same metrics, but it creates a huge bias because of course, if you split $10,000 in monthly investments over 30 years, of course it's gonna look ridiculous. I mean, who invests $27 per month in the stock market? Nobody does that. I mean, remove the trading fees from that and you're already down to 25 bucks. One share of the Vanguard fund costs $72 anyway, so you can't even afford one share a month. So it makes no sense at all. So to cope with that, you could multiply everything by 10 and say, well, let's look at $100,000 lump sum investing versus a $270 per month investment. That's a lot more realistic, right? And with $270 per month, you can actually do something with that money. You can buy a few shares, you can afford the trading fees, so that's much better. And of course, you're still making a ton more money with lump sum investing because you 10x your investment, but you also 10x your losses. You're bleeding even more money when there's a crisis. Again, with dollar cost averaging, you minimize your losses. If you had invested in the Vanguard S&P 500 fund since 1993, $200 per month, you would now be sitting on $433,303. If you had invested $300 per month every month, you would be sitting on $649,955. If you had invested $400 per month, you would be sitting on $966,607,000. And if you had invested $500 per month every month since 1993, you would be sitting on $1,083,258. That's big, right? But it's over. Those 30 years are past us now, so there's no point dwelling on the past. Let's look at a more recent timeline. If you had started with $100,000 in cash at the start of 2022, you would be down $20,000 since the beginning of the year. Compared with a dollar cost averaging approach and $200 per month, you would have slowly invested $1,800 and you would only be down 5% or $92 since the start of the year. And you're probably sleeping better than the guy who's down 20K since the beginning of the year. Dollar cost averaging doesn't necessarily make sense mathematically, but for the average Joe who's looking to get started with investing and build long-term wealth, it simply has too many advantages when compared to lump sum investing. It gives you psychological safety, it allows you to keep cash at hand, it can actually make more money than lump sum investing if you don't do an absolute comparison. For instance, $100 per month over 30 years is better than $10,000 invested once 30 years ago. It also builds amazing financial habits, it forces you to budget and allocate a bit to your savings every month, and you will thank yourself 10 years down the line because that money will have grown exponentially. And if it doesn't, keep investing because it will grow even more exponentially when the economy starts picking up again. And finally, a small increase in monthly contributions has an exponential effect on future portfolio growth, as we've seen. So at the end of the day, pick an investing approach that's best for you, your family, and your financial situation. And remember that usually for the average person that can't put down 10, 20, 30, or 100K, dollar cost averaging will be better because it's better to start small than to not start at all, and your monthly contributions will help make up for your losses when the economy is doing bad, so it's also less stressful. So start slowly, invest regularly, and build your wealth surely. Thanks a lot for watching this video, it means a lot. If you enjoyed it, make sure to like and subscribe to the channel if you haven't already. Remember to also check out my 75 people who do interview series. I interviewed 75 productivity experts on productivity, good work habits, time management, mindfulness, but also financial habits. Check it out, you get a 25% discount because you watched this video. Thanks so much. As always, see you for next week's video. Thanks so much for watching, have a great day, enjoy the journey you're on.